Welcome back. You're tuned in to Chartbusters here on CNBC-TV18. Well, let's focus on another company with Prudent Corporate Advisory Services. The company reported actually a good quarter. The revenues came in line with estimates. The margins and the profitability beat what analysts were estimating. Mr. Sanjay Shah, the Chairman and Managing Director of Prudent Corporate Advisory Services, joins us on the show. Hi, Sanjay. Good morning and thanks a lot for joining in. Well, you have been growing at a very, very solid pace. And even in the past year, you grew by around 37%. However, now the base is higher. Do you believe you can continue to grow at this sort of a run rate? And if yes, what does a revenue mix shape up to be?
So thank you for having me. I think I can tell you frankly, because we are a part of entire wealth management piece of the country, and I believe entire retail wealth management piece is poised for a significant growth from here on. So if you look at our revenue comes from majorly from the mutual fund distribution business and the insurance distribution business. And I believe that the mutual fund retail growth, if you look at last AMFI Vision paper, it says that similar to what has happened in US between 1980 to 2000, the same story is going to happen in India from now onwards to next 20 years. So I think I can assume that bare minimum, definitely keeping in mind some volatility over a longer term period. I think the 20% kind of a CAGR in the AUM looks reasonably better to project for next 5 to 7 years for sure. So
all right, 20%. 20% CAGR over the next 5 to 7 years at least, and that's the AUM for the mutual fund industry. I presume that you would grow a clip faster than that if you have to gain market share. Speaking about market share, monthly SIP flow, you had a target of 1,000 crores per month. You fell short of that in the previous month, but in the previous quarter. But the last month once again saw SIPs move to a record high. Do you believe you can hit this 1,000 crore per month target on SIPs this year? And what about your market share there? It's increased from 3.5 to 3.8%. What are you aspiring for this year?
Yeah, so I think you are absolutely true. I think we would have reached by this time 1,000 crore, but you are right, because the month of February and March was a little bit subdued in the industry. That's the reason I think we were sort of etching those 20 crore. In the current year, we assume that we should reach by end of this year a book of about 1,200 crore. So we are assuming that the run rate of SIP coming from the retail should continue at a healthier pace. And today we have a market share of 3.8%. And I believe we'll try to maintain this market share, because regularly you have been seeing some amount of traction coming from the direct piece also. So I'm talking about the market share of the total SIP book, including the direct piece. And as direct is trying to contribute more and more from the tech platform, if we can maintain our 3.8% market share in the current year, it's going to be a good thing for us.
And the monthly SIP book goes to around 1,200 crores, right?
1,200 crore by March 26, sir.
Got it. All right. Just to reiterate, the top line growth you're talking about for this year is how much?
The AUM growth is about 20% on a point-to-point basis. But I believe as far as top-line growth is concerned, it may not be the same what we have seen last year, because this year, my last year full-year average AUM was about 99,000 crore, which I earned the revenue. When I'm talking to you now, I am now at 109,000 crore. So we are already positive about 8-9%. So full-year revenue growth should be in the range of 18-19%.
18-19%. Got that. Also, distribution of insurance on a small base, that's growing at a fast clip. I think currently it's early teens as a percentage of your mix. Where do you see that number headed?
So I think we are seriously concentrating on the retail health side, and our retail health book is growing very, very rapidly. We closed the year at 150 crore last year, and we are projecting that we should add another 60-65 crore in the retail health side. On the life, we are concentrating purely towards the term and the the guaranteed product for the retail investor. So there also we see a good scope for us to grow at a better pace. So overall, internally, we feel that the insurance should do reasonably better than the mutual fund. There are two reasons: because of the lower base, and secondly, it has a very small, very less penetration in my system.
Okay, so let's talk about the mix itself. 11.5% is what came from insurance products. Mutual funds was actually down 5% in the fourth quarter. Was that lower because, there was softening commissions from AMCs? Do you believe that this is a trend that will continue? Are there any further cuts out there? And in light of that, where do you see your share from mutual funds and insurance be by the end of FY26?
So I think the last quarter insurance has done better than the mutual fund industry. And
Yes.
historically, insurance is always better in the last quarter. That's the reason you would have seen that the share of mutual fund has came down. Otherwise, mutual fund is a very predictable revenue, sir, because you'll see it is linked to the AUM and very, very predictable, you can say. So my belief is that gradually insurance should occupy 1 or 2 more percentage on a year-on-year basis. So today, let us assume that the insurance is about 12% my overall kitty. I assume gradually it should go towards 15-16%.
Okay, all right. Let's talk about operating profit then. The margins actually on a year-on-year basis, on a sequential basis as well, actually it improved. The operating margin that we are working with is around 24.3%. Where do you see this number headed, sir?
I think operating margin should, considering the full year of FY25, I believe FY26 should also reasonably remain steady. Only one thing which I'll just communicate, that we are the very large B2B2C player, and in my system 90% of my revenue and AUM come from mutual fund distribution partner network. If that ratio tilt more towards partner, then you might see some amount of pressure on the payout ratio, because 1% more money coming from MFD, then I have a 60-64% payout. So I think that is the only thing which I think, if the mix change towards the MFD more, then the payout ratio might change, but otherwise I should be able to maintain the operating margin.
Operating margins around this 24%, correct?
Yes, sir. Yes, sir.
And when do you go back to that 28% mark? At some point, do you aspire to do that?
I don't think so, because I think because incrementally, as we are growing, some amount of margin pressure which is already built in. So I think I'll try to maintain the current margin.
All right, 24 to 26%. Thank you so much, Sanjay, for joining in. 18 to 19% revenue growth, 20% AUM growth, a percentage or 2 points higher in terms of contribution from insurance, and SIP monthly book at 1,200 crores by the end of this financial year, with margins between 23 to 24% is what they've guided for. Stock up around 3%. With that,